What's up guys, I'm Lee and welcome to Midwest Invest. Okay, so I don't want to waste any time, so let's just go ahead and jump right into it. So you have three options when you're buying a car. You can pay cash for the car, you can finance the car, or you can lease the car. In these examples, I'm primarily going to focus on financing the car versus leasing the car. So first let's take a look at financing a car. Financing terms typically range from 36 to 72 months, and interest rate for somebody with average to above average credit is between 2.5% and 6%. The national average, according to Experian, is 5.76%. Rates do tend to go up a little further the longer you push out your term, and also interest rates tend to be higher on used cars than new cars. When you're buying a car, whether that's paying cash or financing the vehicle, you will owe the taxes on the entire purchase price when you go to register that vehicle. Unless you live in a state like New Hampshire, and in that case I'm extremely jealous and you have no friends. For the rest of us and our friends, we'll pay the taxes when we register the vehicle. And then of course there's the biggest difference when financing the vehicle, and that is at the end of the term, you own the vehicle. Now when you lease a car, you're essentially paying for the depreciation over the period that you're using that car. Now, unlike buying a car, when you lease the car, you pay the taxes per month on the monthly payment instead of the entire purchase price in the beginning when you register the car. However, there are some states that tend to bend you over on taxes when it comes to leasing a car. That's right, Texas, I said it. Another major difference when leasing a car is that you have a set number of miles, usually between 10 and 15,000 miles per year. So if you're somebody that has a really long commute or just likes to go booze cruising all the time, then ignore everything I'm saying because leasing's not for you. And of course there's the biggest difference between financing and leasing a car, and that is at the end of the lease you don't own the vehicle. So then there's the question, should I buy new or should I buy used? And that really depends on what your goals are. When you're leasing a vehicle, typically you're going to lease a new vehicle. But when you're buying a vehicle, you can buy a new vehicle, you can buy a 3-year-old vehicle, you can buy a 50-year-old vehicle. It's whatever you want to do. And one thing I wanted to bring up in this video, which is something that I don't hear talked about, which is kind of the whole purpose of making this video, is how the time value of money can play into a car purchasing decision. The time value of money is essentially the idea that money that you have in your pocket now is worth more than that same amount of money in your pocket down the road, whether it's years, months, whatever. We can apply the time value of money to get a good estimate of if we invest the money that we save on various car payments, how that can make one decision make more sense than the other. So let's take a look at that. I'm going to give you an example, and I'm going to base this example on the truck that I own. I drive a Ram 1500, and it's about a $30,000 truck new. There was a really good lease special going on at the time that was $1,000 down, $199 a month, and the car payment on a $30,000 car, usually a good rule of thumb, is about $20 for every $1,000, give or take. Financing the truck will cost you $537 a month, whereas leasing that same truck will cost you $215 per month. So that's a $322 difference in the monthly payment amount between financing and leasing the same truck. So based off the monthly payment alone, leasing looks better on the surface. However, what you have to keep in mind is at the end of the lease, you don't own that truck. So let's assume that the $537 per month, which would be your car payment on your new Ram 1500, is the total monthly car budget that you have. Now in the buying example, the first 5 years you can't invest anything because your entire $537 is going towards your car payment. However, the second 5 years you have $537 per month to invest because you don't have a car payment. So let's break that down. So after those 5 years of investing $537 per month, you'll have about $37,000. Now in the leasing example, your car payment is only $215. So if you subtract your monthly car budget of $537 minus the lease payment of $215, that leaves you with $322 left over each month. Now, if you take that $322 each month and invest that at a 6% interest rate every month throughout the 10-year period that we're talking about, then you would come out with a total of about $53,000. Now, you might be thinking, if I got $53,000 with leasing and I only get $37,000 from buying, then leasing must be the clear winner here. But what you have to take into account is that after the loan, you own the car, which is also an asset. The Kelley Blue Book price for a Ram 1500 that's 10 years old with about 100,000 miles on it right now is $11,000. So you have to add $11,000 to that. So that gets your grand total up to about $48,000. So in this 10-year example, you still come out about $5,000 ahead in the leasing example. Now, the longer you keep that truck that's paid off, the more and more it makes sense to buy versus lease. And that's why you have to go into buying a car knowing well ahead of time how long you plan to keep that car and sticking to it. The average person in America keeps the same car for 7 years, and based off the statistics that are out there of what the average car payment is, how long people are keeping their cars for, if you actually take advantage of the time value of money and invest your car budget per month, then for most people, including myself, leasing is the winner here. Now, before all you Dave Ramsey fans show up at my front door with pitchforks for suggesting that leasing might be a better option than buying, let me give you the last example here, and that's buying a used car. Most financial advisors are going to say that the best thing you can do is buy a car that's 3 to 5 years old and drive that shit into the ground. When I say drive it into the ground, I don't mean drive it 5 years, 7 years. I'm talking drive that car for 20 years until it has 300,000 miles on it and the tires are falling off and it's starting to catch on fire. And the reason that it's 3 to 5 years is because a car is going to see a majority of its depreciation after 3 years, and then it starts to curve down after that. The Kelley Blue Book value for a 2015 Ram 1500, it's about $20,000. Your monthly car payment on that is going to be about $351 a month, and that leaves you with $186 per month that you can invest. So you have $186 per month for the first 5 years, which is going to net you about $13,000 after 5 years. After 5 years, you own that truck, and so you don't have a car payment, so you can invest the full $537, which will get you about another $37,000. However, at this point, the truck's much older, it's not worth as much, so the truck that you own that you can sell is worth about $4,600. So that puts you at about $55,000, so about $2,000 savings over the lease option in this 10-year example. And again, the longer you keep that truck, the more and more it's going to pay off. So just like I decided that leasing was a better decision for me because I know that I'm going to want to drive a new car every so often, and I like driving a new car, doesn't mean that that's the right answer for you. If you're the type of person that just wants the most frugal thing, then buy that used car 3 to 5 years old and drive it into the ground. Let me know what you thought about this video. I am looking for feedback, so if you think something could have been better, if you think I'm wrong, if something I said made you think a different way, then I want to know. So please leave a comment below. Most importantly, hit the like button and please subscribe because I've got a great video coming up for you next week about private mortgage insurance. Thanks.